Welcome back to the Market Trader Options Basic. This is a video recap series for Lesson 2, and in this video we are going to be looking at the put option payoff diagram, which is actually very similar to the call option. It's really just the inverse part of it. So most of you, when you buy stock, you want it to go up in price. But there is an instrument called a put, which allows you to profit or hedge or have it gain value when the instrument actually falls in price. So this is an example where we're looking at the USO ETF, which is an oil ETF. It's come down in price quite a bit. It's currently trading, I think, around $8, $8 to $9 area. And if we were concerned that oil would still be falling, meaning the price is coming down, what are some ways that we could profit or protect a position in the case of a further downturn in oil? So one way to do that is to buy something called a put option. So like the call option, put options expire. So this particular one here is showing 28 days to expiration again. So it's around a month. And again, we are going to be looking at the black line. So again, I'm just going to mark in the black line is the value of the put option at expiration. And you can see that as the price falls, as we go from say $10 to $5, the actual value of this put option begins to increase. So at $5, this is worth maybe around $175 per contract. So if oil were to drop another $2 or $3, we could expect that this put option to gain in value. So again, before like the call option, what is our strike price for this put option? Well, we look to see where the put option changes or inflects from the horizontal line again to an increasing line, an increasing slope line, and we see that somewhere around $7 to $8, it would be the actual strike price. So let's just call this a $7 strike put option. So that means anything above $7, the price of this option will not make any money. In fact, our maximum loss looks like it's going to be about halfway between 50 and 0. So we'll say that our max loss is going to be $25. Okay, so that means the most we can lose with this option is $25 if the price of oil remains above the $7 strike. If, however, it begins to move down, we will start to make money. So at the $5 strike, like I had mentioned before, we would be making about 175. If we went halfway down below that, between the 0 and 5, say 2.5, and traced up to the expiration, the value of this put option would be somewhere around 425, just between $400 and $450. So let's say about 425 would be the value of that option. Now, unlike the call option, our max profit for this option is not infinite because no matter what happens, we can't get lower than a $0 amount. So our max profit would actually be when if somehow the price of oil got to 0, and that would be looking like around, it's below 700, so let's just say around $675 per contract would be our maximum profit because we can't get below 0. So this is a very similar instrument to like a call option. Again, we don't expect the price of oil to get to 0, but it's possible that it could decline a little further into the $5 range, and it's also possible it could bounce and go higher up to maybe the $10 range. So we'd be looking for our profits somewhere maybe in that range over the next 30 days. So that's a recap of how a put option works. Make sure you take a look at the other video on the call options, and we'll see you on the next video recap.